Hello.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grandy.
Bye. And welcome to my podcast. Hi, I'm your host, Phil Grandy at philsgang.com. Now, we had a pretty interesting day yesterday. I told my members back in February of 2000 and I told my members in February 2025, I said, the one thing I can assure you where we're going to make money is in the gold miners. I said, gold is going to go through the roof, okay? We know that. And of course, we were right. And so we bought the gold miners. And the gold miners just, we've done terrific with it. Now, yesterday, gold hits 4,000. Now, what people don't understand is when gold hits 4,000, gold sends a message. The one thing that Wall Street hates, the one thing that the Federal Reserve hates is gold. They try to suppress it as much as they can. They try to beat it down, suppress it. Because gold will tell our lenders, Japan, China, the UK, those are our banks, that we are in trouble. When gold goes up, they view it as the United States is weak, and we want more interest if we're going to loan them money. So they always try to suppress gold. You can't suppress gold because look what's happened since 2000, starting under the Biden administration to where we are today. That whole administration is just, and not getting into the politics, it's just the facts. I mean, the economy was just destroyed. The inflation went to 9%, driving gold to the roof. And gold keeps going up, warning, hey, the internals in your stock market, be careful. The internals in your economy, be careful. Something's wrong. And when you hit 4,000, it's a big red flag. But it's being ignored. The jibber jabbers on all these financial shows are ignoring it. And now you combine it with all this AI hosting business, which has gone nuts, okay? And no one, investors, the only investors that understand that gold is sending a message that something's wrong with all this AI, okay, are the institutions. Now, when you talk about institutions, you're talking about your smart money, okay? You're talking about your big insurance companies, your 5 biggest banks. I mean, you're talking about the the biggest institutions, hedge funds, 401ks. You're talking the biggest and the brightest, and what they are saying is, again, we're dumping our stock. We're going to dump our AI stock. We're going to start dumping our semiconductors. This is what they're driving, and that's what's driving all this AI is the semiconductors. And they've been dumping the semiconductors, but it doesn't show up in the S&P. In fact, the S&P keeps going up and up and up and keeps hitting new highs. I think it was 54 new highs or 57 new highs in 2024 and 2025, or I think we're about 30 or 35. That's insane. That's insane. And it's all driven by these stocks that are tied to this hosting, AI hosting business. So gold has sent us a message, and the big institutions are dumping. It's not showing up in the S&P because Wall Street's smart. They did the same thing in 1929. They make sure there's enough money in margin accounts so that when the big institutions dump, you don't see the S&P going down. If you put enough money in margin accounts, what we call is the tourist investor, not the retail investor. He's retail, but we call him the tourist investor. A tourist investor, they're gamblers, they're impulsive, they're driven by fear of missing out. They always buy right at the top, right at the top. They have no discipline. They're detached themselves from reality. They're gambler mentalities. The retail investor is people like me, okay? And that we treat it like a business. We want to learn. We want to understand how the bond market works. What message are we getting from the bond market about the stock market? What message are we getting from gold about the stock market? What message are we getting from all this AI nonsense? So the 4,000 yesterday was the biggest red flag that we've seen yet. And what happened yesterday? You started to see the institutions pouring what stocks they still have left. They're dumping and pouring into, again, your discretionary stocks, okay, and your discretionary and your other mostly discretionary, I should say. Okay, that's your XLP and your XLY. Okay. And I think it was XLY is the one they really went after yesterday. The consumer discretionary, right, XLY, they went after that. And they also went after XLP yesterday, which is our consumer staples. XLP, consumer staples. I always get those two mixed up. So staples and discretionary. They jumped in there, dumping tech, and boy, did the tourist investor jump in and buy all that tech stock. Okay, just soaked it all up. Now, the jibber jabbers on these TV programs will never tell you the truth. They're in industry. They're there to use the retail investor. Commission, ka-ching, 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 ka-ching. That's why they always lie to you about shorting. They always make you fearful in shorting. Oh, don't ever short. You're going to lose everything. You're going to lose your house, your kids, everything, which is a bunch of BS. You want to lose everything? Don't short. A person who doesn't short because they're fearful is like a person who would buy a car with no reverse. It's just out of fear. It's just stupid. Okay, but it's not stupid in the sense that the person's dumb. It's just they've been convinced by Wall Street. Oh, don't you dare short. So gold is going through the roof, and everybody's now jumping into discretionary stocks. What's that tell you? Okay, we're going to get a crack. Okay, we're going to get a crack in the margin accounts. That's where you show, where it shows up first that the stock market's going to crash. It did in 1929. It did it in the 1970s. Did 1987. Did 2000. It did 2008. It did 2018. It did 2020, and it's going to do it again. Okay, that's where it shows up. Why? Because Wall Street's clever enough. They know the mentality of the tourist investor. They know he's a gambler. He's impulsive. They're going to make sure they give him plenty of money to go out there and buy when they shouldn't be buying, okay? So when we hit 4,000 yesterday, that was the siren that went off. Now, look how they contradict themselves. Look at this. Listen to what they said. Remember NVIDIA? When NVIDIA went nuts, I think NVIDIA went crazy the first time on September 23rd. September 23rd. Listen what they said about NVIDIA. These are the jibber jabbers on CNBC and Fox.
The S&P 500 gained 0.4% on Monday with a huge boost from the 4% jump in NVIDIA after the chip company announced a $100 billion investment over time into OpenAI to develop data centers for AI training together.
Okay, well, everybody's happy. Man, NVIDIA took off, went up there. You got to get in this stock. It's unbelievable. These AI center these open AI deals they're doing, and these AI hosting business is just unbelievable. The next day, they go, oops, we're sorry. NVIDIA went down.
The S&P 500 fell 0.5% on Tuesday, dragged down by 3% or somewhat greater declines in the shares of NVIDIA, Amazon, and Oracle. Scrutiny of NVIDIA's $100 billion deal with OpenAI, investing in the company, which would then recycle some of the money back to buy NVIDIA processors, raised some questions about the underpinnings of demand in the current phase of the aggressive AI build-out.
Gee, the thrill of victory, then the agony of defeat. Well, let's get some victory back again. The next day, or about 6-7 days later, oh, man, we have renewed enthusiasm in AI and the hosting business.
The S&P 500 index fell 0.4% on Tuesday, a mild decline thanks in part to strength in some defensive areas such as utilities and consumer staples. Shares of Oracle shed more than 2% on a report by trade publication The Information that its AI data center hosting business has so far shown thin profit margins.
So you had the first deal, again, on how great AI was, right? That was on September 23rd. And then September 24th, it wasn't so great. And then yesterday, we got another problem yesterday. People were again, dumping because we have industry publications, and these magazines and these publications that follow the industry came out and said, this is nuts, that we're not getting any returns. Investors are getting upset that hundreds of billions of dollars they're putting in, they're not catching any returns. And remember, Jeff Bezos came out. Jeff Bezos came out and said, this is nothing but a big bubble. And he's saying that this is crazy. It's nothing but, again, a bubble. That's what he's calling it, a bubble. And he's saying the hype is bigger than the profits. He said, this is worse than the dot-coms. This is worse than the dot-coms. The hype is so unbelievable. Now, so yesterday, all of a sudden, more institutional money dumping AI, okay, and they jumped into, guess what? They started going back into staples and discretionary stocks, going into Coke and Pepsi, then they're going to Nike. They're getting out of these stocks. But again, you don't see the S&P going down because Wall Street, just like they did with the dot-coms, they made sure there's plenty of money in there and these margin accounts, so that the tourist investor, who are gamblers, who are impulsive, they don't know any difference, they're looking for the leverage, they're looking for their big hit, okay? They keep on borrowing and borrowing and borrowing. So every time these institutions dump another AI stock, like Oracle, who buys it? They do. They go in and buy it. They buy all these AI stocks. But you don't, that's why you see the S&P going up and up and up and up. And there's never going to be a crash. Well, they don't understand what's going on. You have the tourist investor in there, just like the dot-com days, and you have Wall Street making sure there's plenty of money to suck them in, to keep holding it up and holding it up. And this can go for a very, very long time. This can go for a very, very long time. But we also are seeing something else going on now. We're starting to see the dollar. The dollar, remember, the dollar has been going down and getting weaker and weaker and weaker. But as I pointed out to my members, if you look at the dollar right now, that weak dollar was taking care of these tech stocks. That weak dollar was taking care of these gold stocks. But now what we're seeing, and we're getting to a very dangerous area, if you look at the dollar and you go back and you see the consolidation between let's say April of 2025 and where we are today. It's been forming a base. They've been trying to break it and they can't. Now, if this dollar, which is now sitting on support, the 50-day moving average, if this dollar breaks out up through the 200-day moving average, that's going to be a real problem because gold's going to start coming down, okay? And also, you watch what happens. Interest rates aren't going to go down. You're going to see interest rates going up. Remember, Powell made a huge mistake. Powell should have been raising rates to fight inflation. Our inflation's going up. You still go to the grocery store? I do. I don't see prices coming down. You know what they do? They lie again. What they do is they measure the rate at which inflation's slowing. They're not saying an apple went from $5 down to $2. They don't measure that. They measure the speed at which it's pulling back. And guess what? It's not pulling back. So what we're seeing now is between what's going on with the dollar, if this dollar keeps going up, that means we lose our leverage. We lose our leverage, again, on gold, because gold loves weak dollars. And also tech stocks love weak dollars, but now if those dollars go up, that's going to be a problem for the tourist investor who is in debt. And here's another thing that's going on. they're going to have to raise rates because Powell lied. Powell said he's cutting rates so that he can give a break to the corporations, and the corporations will start hiring like crazy. No, they're not. No, they're not. They're not hiring. They're cutting. The problem isn't, oh, if you just give us a rate cut, we'll be fine. No, their problem is they have no confidence in the economy. Not when you have 40% increase in bankruptcies for small businesses, and when you have 24%, again, increase in bankruptcies for just Main Street. He's going to have to raise rates. More when I get back. Phil's gang. Join my gang. Free for 10 days.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
What does it take to be a successful investor in the stock market? Developing your skills and learning from an expert like Phil Grandy and philsgang.com.
It doesn't have to be hard or complicated to learn how to invest in stocks properly. It's like anything else. You're going to golf, or you're going to learn how to play tennis, ski. You need to be with someone, learn off of them, one-on-one. Now that can be really expensive, cost thousands of dollars. But I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grandy has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro. Phil Grandy. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com.
Welcome back. Learn, invest, and make profits with Phil Grandy. Simply go to philsgang.com. Now, here's Phil.
Okay, so welcome back. So we're talking about, look, it's obvious that this is just a typical, or this is not a typical, I shouldn't say that. This is an unusual rally, an incredible rally. We thought the dot-com rally was something. That's nothing compared to this bubble. This is a huge bubble. And the one problem with this is every time that you have these corporations doing stock buybacks, the amount of stock buybacks are incredible because they don't have to have profits anymore. They don't have to have sales anymore. Remember, it always used to be profits, okay, earnings. Earnings is the business that you drive, and profits after your expense, there's your profits, right? So business, profits, mother's milk of the stock market. No more. Not once they started with these, with stock buybacks. You just buy your own shares back. It pushes up your earnings and it pushes up your profits without having them. That's why it was a crime. It was a crime. That's right. Up until Reagan, and Reagan made it legal because he took over from the peanut farmer, Carter, and he had a hell of a mess. So he decided, hey, we got to get the stock market moving up. So let's use stock buybacks, which is a crime. Okay, I mean, just think, you know why stock buybacks are a crime? They used to be a crime because you're inducing people to buy stocks. with no profits. It looks like the company is doing well. It looks like, look at, boy, the price going from $100 to $200 to $300 to $400, but it's not going up because of profits. It's going up because of financial engineering. That's why it was a crime. You're sitting there and you get a tourist investor, not a retail investor. Remember, a tourist investor, he's a gambler, he's impulsive, he's driven by fear of missing out, he has no discipline, he doesn't want to learn, and he loves leverage. And all he sees is the stock price going up, and he goes, oh my God, I got to get in, I got to get in. And so they suck him in and they give him a big a margin account, and that's Wall Street. It should be a crime. You shouldn't get, it's like giving somebody who's hooked on cocaine more cocaine. But stock buybacks creates a guaranteed boom to bust stock market. Think about it. Business investment provides stability in an economy. When you used to go and take money and put it into new equipment, into IT spending, put into new trucks and manufacturing equipment, and you started to increase your business, and you could manufacture 5,000 chairs, okay, instead of 1,000, and your payroll was no different. Then all of a sudden the company's making money and they can pay more bonuses, start paying benefits. It was a wonderful thing. They don't do that anymore. They don't have to have profits anymore. So what happens is you have a boom to bust business model. And it's okay. Wall Street, they love it. They don't care. Congress loves it because Congress is always inside trading. You would think somebody would say, what the hell is this stock buyback? That's a crime. You're inducing me to buy a stock that was at 20, now it's at 100. But it didn't go up there because of business investment. That doesn't provide a stable economy. When you're doing stock buybacks to move up your stock price, that's not, how can that be a stable economy? It's not driven by the working middle class, no more. No, we don't need them to work. Why? Because we can show profits without increased business, without increased sales. So business investment has been replaced by, again, fueling this obsession with stock buybacks. And what it does, it reinforces our unstable economy. That's what stock buybacks do. It enforces our unstable economy. It props it up. We're dependent on increased debt. Corporations are dependent on increased debt. And Wall Street has to depend on making sure they're going to loan money to tourist investors who are gamblers, who are impulsive, okay, who love risk-taking. They're going to give these people more, like, let's say they're cocaine addicts, they decide to give them more cocaine. That's what they're doing. They give these people who shouldn't have money, they're giving them more money to buy more stocks. And what's inducing them? They see the stock going from 20 to 30 to 60 to 80, 200, 300. They say, oh, gee, they must be doing good business. No, they're not doing any business. They haven't grown their business. They had $1 million in sales when the stock was 20. Now the stock's 200. They still do the same 1 million. And when the stock's 500, they're still doing the same 1 million. Now, I'm exaggerating for the purpose of this discussion, but you get my point. And that's why Jeff Bezos said yesterday that this is terrible what's going on, this AI hosting business. It's all hype. So again, you got these corporations that are dependent, okay, on to fuel these stock buybacks, okay? So our corporations need help from the government. Our corporations need to go into debt. Because remember how they do it. They'll print money. The Treasury prints money, gives it to the Federal Reserve. The Federal Reserve puts it in the banks and tells them, don't loan the guy in the street needs help. Take that money and give it to Joe Schmuck, okay, and his tech stock. He's going to buy his own tech stock back. So just think about this. Of the S&P 500 companies, just 20 of 500 companies account for 50% of all stock buybacks. What are you, nuts? What are you nuts? 20 of 500 companies account for 50% of all stock buybacks. That's nuts. That's insane. And the IT sector is dominated. 276 billion. That's 28% of the S&P total. Think about that. The IT sector is dominated by 278 billion. That equates out to 28% of the S&P total. What are you, nuts? This is insane. And now, it used to be that you'd look at the bond market. The bond market would tell you which direction the stock market's going to go. Is it going to go up or is it going to go down? It used to be simple. If you have rising yields, that tells you that tech stocks aren't going to do well. And that's telling you that you better switch to value stocks and dump your tech stocks. Now, when you have bond yields going down, that implies there's going to be, that's a benefit for growth stocks. Low interest rates, you have growth stocks. That's going to help with the growth side. It always tells you what to be in. No more. Doesn't matter. Just always make sure you're in stocks that are being bought by companies, doing stock buybacks and that are being bought by tourist investors on every dip. So the S&P keeps going up and up and up and up. And again, while the big boys are in there and they're dumping the stock, the tourist investor comes in and buys on that dip. So they camouflage it. It's just insane what's going on. So again, the boom to bust has been created. Okay. Now let's go talk about a little bit about the what's going on with the S&P and with in these stocks like Walmart and Costco, and you got to be very careful right now, because watch that dollar every day. If that dollar keeps going up, I hope to God it doesn't, but if it keeps going up, and remember, the dollar's been terrible. The dollar is so weak. It's all it's been doing is helping tech stocks, but the dollar, no wonder things are so expensive at the grocery store. We got to get the dollar to be stronger. There's no buying power. There's no purchasing power. And you just take a look at the challenge since December of 2024 to where we are today. The dollar is nuts, okay? The dollar was at around $30.27, and it got to a low of around 27. Today it's now back up to 27.79. Remember, the 200-day moving average is right around that 28. We're at 27.79. 200-day moving average is around that 28. That's not far from testing that 200-day moving average. If we break up through that 200-day moving average, goodbye your tech stocks, goodbye your gold. But see, for my gang members, we're fine because we know how to sell short. And by the way, what people don't understand is no professional is ever surprised by a crash or a crash in an individual stock even, okay? If you're a professional and you have the skills of going long and short, and you understand how the market works, okay, you always have a heads up when the market's going to turn against everyone. And the biggest place to look are in these margin accounts. When those margin accounts start breaking down, every stock market crash from 1929 to 2008, every one of them told us well in advance that we were going to have a crash, and we are set up to short. We set up early to short because the first crack is always in the margin account, okay? So gold today, it's just amazing what's going on. In 4,000 an ounce, that's just incredible, isn't it? Just crazy. So what can cause a crash, okay? Well, a strong dollar, We've been talking about that this morning, right? This afternoon, rather. A strong dollar, that's bad for tech stocks, bad for gold, bad for crypto, Widening credit spreads, that warns you too. That sends a red flag when you have widening credit spreads. That signals a possible recession. It also signals a crash, as there's more demand for treasuries than corporate bonds. So if you know what you're doing, you know what to look at. You always know when a correction's coming, when a crash is coming. And that's why you look at widening credit spreads. That's another big signal, another big red flag. That's another big red flag. And again, but when we hear all this stuff, here's the problem with the market besides the stock buybacks. Listen to the nonsense you hear every day. Listen.
Yes, the economy is strong, stronger than probably even we thought starting the year. At
you know where Atlanta Fed is. You looked, right?
I know.
3.4.
Yeah, about 2.5–3% growth, which means and has translated into much better earnings. And that's really what
No, that's a lie. That's not earnings. It's fake earnings.
2 minutes.
It's total fake earnings. It's stock buybacks. Look, take Apple. In the past 10 years, they bought back $735 billion. I mean, $730 in stock buybacks. Wasn't earnings, okay? And if you take Meta in the last 10 years, $207 billion they bought back. NVIDIA, over 10 years, $89 billion. Google, $317 billion. Let's just go back and take over the past 5 years. Apple, again, another $460 billion. This is insane. Meta, $177 billion. This stock buybacks has gotten crazy. It's gotten out of hand. And think of the money supply. That's what's driving. Remember, they keep increasing the money supply. If it wasn't for the increase in money supply, and by the way, that's inflationary. That's why they lie about inflation. Inflation's still 9%, but they lie about it. So again, the money supply drives the returns, these stock buybacks. So if you think about, you only have a handful of stocks that are driving the S&P 500. There's only a handful of stocks. It's about 5-6 stocks driving the whole S&P 500. Google's up, 47% in the first 6 months? Amazon, 27%? Come on. Look, we can help you here at Phil's Gang. We know how to trade a market like this, and we know how to make money when it eventually goes down. Until then, stay long, put your stops in, learn.
Listening to Phil's Gang with your host, Phil Grandy, on the Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.